The markets are closed, and the screens are dark across Wall Street. But something extraordinary is happening behind closed doors this holiday weekend. Emergency risk management meetings are taking place at the highest levels of the global financial system. And the reason is simple, yet terrifying. Silver rose 10% in a single day, and when a core commodity moves that fast, it does not just create a trading event, it creates a solvency event that threatens the entire structure of modern finance. When silver jumped to $79, it broke the risk models that every major bank uses to calculate their exposure and manage their positions. The hedge funds that were short silver suddenly found their margin requirements exploding beyond their available capital. Most dangerously, the clearinghouse, which guarantees every single trade in the market, is now facing the nightmare scenario, where a major institution cannot pay its debts on Monday morning and the entire system could freeze. The clearinghouse is the central spine that holds the financial markets together, and if it fails, everything stops. If a bank defaults on its silver obligations, the clearinghouse must cover the loss from its default fund. But that fund is not infinite, and with billions of dollars in short positions outstanding at $79 per ounce, a few more upward gaps could drain it completely and trigger a systemic collapse. This emergency broadcast will expose what is really happening in those closed-door meetings this weekend. We will analyze the playbook that banks use when they are cornered and desperate. We will examine the potential for rule changes that could be announced Monday morning, including margin hikes, position limits, trading halts, and even the nuclear option of liquidation-only orders. These meetings are not a sign of strength, but rather proof of total loss of control. To understand the panic, you must understand the mathematics of leverage that governs modern banking. The banks do not trade silver with their own money, but instead use borrowed capital with leverage ratios of 20 to 1 or even 50 to 1. This works beautifully when markets are quiet and generates enormous profits. But when prices move violently against leveraged positions, the losses multiply instantly and can wipe out entire institutions overnight. Let me show you the simple math that is terrifying the boardrooms right now. If a bank uses 20 to 1 leverage and the price moves just 5% against their position, they lose 100% of their equity, capital, and become insolvent. Silver moved 10% on Saturday, which means any entity leveraged 10 to 1 or higher on the short side is mathematically bankrupt, right? Now with losses exceeding their total available capital. Usually when this happens, the bank simply issues a margin call and forces the client to deposit more money or liquidate. But what happens when the client is too big to fail? What if the entity that is insolvent is a massive sovereign wealth fund or another systemically important bank that cannot be liquidated without crashing the entire global market? You cannot just force them to sell, because that selling would crater the price and trigger contagion. So instead, you hold emergency meetings and call the regulators and summon the Federal Reserve officials. You tell them we have a problem that threatens the system. If the market opens normally on Monday morning, Bank X will default on billions in obligations. We need a solution immediately, and that solution usually involves changing the rules to protect the banks at the expense of everyone else who played by those rules. This exact scenario played out in 2008 with Bear Stearns when the banks were caught holding worthless mortgage securities. It happened in 1998 with long-term capital management when a hedge fund nearly destroyed the system. It happened in 1980 when the Hunt brothers tried to corner the silver market and the exchange simply changed the rules mid-game to prevent them from winning and collecting their profits. Right now this weekend, the same playbook is being dusted off and updated. They are discussing containment measures and coordination strategies. They are trying to figure out how to prevent silver from opening at $85 on Sunday night, because if it gaps that high, the insolvency spreads from individual clients to the banks themselves and then to the clearinghouse, and then the contagion becomes unstoppable and the system breaks. The CME Group, which operates the commodities exchange, maintains a default fund contributed by all member banks as insurance. If one member fails, the fund covers their obligations and keeps the market functioning. But the fund has limits, and with silver at $79, the notional value of outstanding short positions is measured in tens of billions. If the price continues rising, the losses could exceed the entire size of the default fund. This is the nightmare scenario that keeps central bankers awake at night. If the default fund is drained, the exchange itself faces bankruptcy. When that happens, traders lose confidence and stop participating. Liquidity evaporates and the market freezes solid. To prevent this outcome, the exchange has emergency powers written into its rules, allowing it to halt trading, raise margins to 100%, or force liquidation-only orders. The lawyers and executives are reading those rule clauses very carefully this weekend. They are looking for the legal justification to turn off the buy button, just like they did with nickel futures and just like brokers did with. Do not think for 1 second they will hesitate to use these powers. They will do absolutely whatever it takes to preserve the structure and stability of the market, even if it destroys the credibility and reputation forever. Now let us examine the collateral crisis that is compounding the silver problem. Banks use government treasury bonds as collateral to back their commodity positions and margin requirements. But right now, the bond market itself is wobbling under the weight of massive government debt and rising inflation expectations. The value of that collateral is falling at the exact moment their liability from silver losses is exploding, creating a devastating double squeeze. This forces banks to sell other assets to raise emergency cash to meet margin calls. We might see stocks crash on Monday, not because equities are fundamentally weak, but simply because banks need to liquidate something to cover their silver hemorrhaging. We might see cryptocurrency markets dump for the same reason. This is how a silver squeeze morphs into a systemic macro event that sucks liquidity out of everything. The emergency meetings this weekend are not just about silver contracts. They are about preventing a broader liquidity crisis that could cascade through the entire financial system. They are attempting to ring-fence the explosion before it spreads to other markets. But here is their fundamental problem. They can control and manipulate the paper futures market through rule changes, but they cannot control the physical metal market whatsoever. They cannot control what happens on the Shanghai Metals Exchange. They cannot control the premiums that coin dealers charge for actual metal in your hand. If they artificially cap the price on the Comex or shut down trading entirely, the physical market will simply the price in Shanghai will rocket to $100 while New York stays frozen at 79. Every single ounce of physical silver in the West will flow east instantly to capture that arbitrage opportunity. So their solution creates an even bigger problem because it drains the Western vaults faster. They are completely trapped between a paper market they control and a physical reality they cannot manipulate. Now let us discuss the psychological warfare and propaganda we are about to witness. When these emergency meetings happen, the banks always leak carefully crafted narratives to the financial press to shape public perception and behavior. Expect headlines Sunday afternoon saying regulators are monitoring commodity volatility or banks assured the public that liquidity remains sufficient, or financial experts warn of dangerous silver bubble forming. They will try desperately to talk the market down and scare retail investors into panic selling at the Monday open. They need your physical metal and your contracts. They need your liquidity to cover their catastrophic mistakes and survive. But this time, the narrative might not work like it has for decades. The public is no longer blindly trusting the banks and mainstream financial media. They are looking directly at the price action. They see silver at $79. They see gold breaking 4,500. They see the truth emerging through the propaganda fog. The confidence game that has sustained fiat currency is failing, and when confidence evaporates, meetings cannot restore it. As we wait nervously for the Sunday evening market open, the tension across global finance is at maximum levels. The meetings continue, and the bankers are desperately searching for a bailout or rule change that saves them. But they are running out of time because the sun is already rising in Asia and the markets are about to reopen. The verdict on their emergency plans is coming, and the whole world will see whether they can regain control. The game has always been rigged in favor of the banks, but right now, that rigging is backfiring spectacularly. The massive leverage they used to suppress silver prices for years is now the leverage driving it higher faster. The rules they wrote to protect themselves are now trapping them in positions they cannot exit. We are witnessing a system failure happening in slow motion, and the result will be true price discovery. The market is trying desperately to find the real equilibrium price where the banks stop leading. That price is much, much higher than $79 per ounce. The emergency weekend meeting is the clearest possible signal that we have reached their pain threshold and broken their control. Now we will see how they react. Will they fight with more manipulation, Or will they finally fold and let the market be free? One of the most common tactics during a commodity squeeze is the margin hike. We already saw them try this approach last week when they raised margin requirements by 50%, but it did not work because the buying pressure was too strong. They can go further, though, and raise margins to 100%, meaning traders must pay full cash for positions with zero borrowing allowed. This kills over-leveraged speculators, because if you are a hedge fund using 50-to-1 leverage and suddenly you need full cash, you must sell immediately. You cannot afford to maintain the position. This creates forced selling pressure that the banks hope will crash the price. In 1980, this tactic destroyed the Hunt brothers and forced them into bankruptcy. But today is different because the major buyers are not using leverage at all. Samsung buying silver for electronics manufacturing is not using margin. The People's Bank of China accumulating strategic reserves is paying cash. They are not affected by margin hikes whatsoever. In fact, the whales prefer margin hikes because it shakes out weak hands and lets them buy cheaper. The next tool in the playbook is position limits, where the exchange simply declares no entity can own more than 3,000 contracts. If you currently hold 5,000 contracts, you must sell 2,000 by Monday noon or face forced liquidation. This is direct intervention designed to break up concentrated positions. But capital is fluid like water and flows around obstacles. If Comex limits positions, the big money simply moves to over-the-counter markets or London or Shanghai. You cannot stop a global shortage by putting speed bumps in one city. The final nuclear option is liquidation-only mode. This is where the exchange announces you can sell contracts, but you cannot buy new ones. They literally turn off the buy button and guarantee the price falls because there is no demand allowed on the platform. If they actually do this, it will be the absolute end of the Comex as a credible marketplace. Investors will leave and never return. They will move to exchanges that allow free markets. Shanghai is open for business and Dubai is open for business. If New York closes the door to free price discovery, they are simply handing the keys to the global silver market to China permanently. The geopolitical cost of that decision is too high for the dollar system. They might threaten it, but pulling that trigger is financial suicide for American hegemony. So, the banks find themselves trapped in a box. They have tools available, but every tool carries catastrophic costs. Every intervention accelerates the flight away from dollar-denominated assets. Every rule change proves to the world that the system is rigged and broken. They are trying desperately to extinguish a fire by throwing dynamite on it. This weekend meeting is their attempt to coordinate a soft landing that lets prices rise slowly enough not to bankrupt them. But markets are not manageable when they go vertical. The crowd psychology has taken over completely and the crowd smells blood in the water. Monday morning is coming. The judgment is coming, and the world will see whether the emergency weekend meetings produced a solution or simply delayed the inevitable collapse by a few hours. The greatest show on earth is about to begin.